Hello everyone, this is Abhijit Chatterjee recording our weekly session of Chartsarefun. This is for the week of March 16th, recording this on the Sunday of March 22nd. We don't provide any investment advice. Our key goal here is to share fun chart patterns. That's why we call our site Chartsarefun. There's tremendous amount of insights in these charts. We basically share technical analysis on different market indices and stocks and ETFs and so on. But the goal is not to then use that as an investment advice because we are not registered investment advisor, but to use those patterns to guide your investment decisions. So Chartsarefun, our blog site, it's a Substack site, chartsarefun.substack.com. We appreciate you subscribing to it with your email, and then for free when these blogs come out daily, you'll get it around 7 a.m. in the New York time. Our YouTube site is Chartsarefun. We hugely appreciate the new subscribers that have come on to our channel. We really appreciate for those that are new to the channel to please subscribe to the channel. And then if you do like the videos, to hit the like button. If you look at some of our key videos that we have shared in the recent couple of weeks, one was we talked about watching out for a reversal in the emerging markets. Today, I'm going to in particular talk about a key emerging market, India. The key index there is NIFTY. So we're going to look at the NIFTY index and see what the chart is telling us. And then the last week's video was about S&P 500 potentially repeating like a collapse from the 2015 timeframe, but we had talked about a key support level at 6,500, maybe S&P testing that, having a reversal higher from it, and then a breakdown. So we look at the S&P 500 chart as well. And then finally look at the key sector that's been driving momentum in the American indices, QQQ, the Nasdaq-100 index or ETF, QQQ, and a couple of key sectors in there on the technology side, softwares and semiconductors. With that, let's go straight into the Nifty chart. This is the daily chart pattern of Nifty. This is the very well diversified. There are two key indices in India, the Sensex, which is 30 stocks, a lot like the Dow Jones Industrial, and then Nifty is a more diversified index. And in this particular case, in the Nifty, what we see is a dome-shaped topping pattern. A key breakdown level was 24,700. We can see that horizontal line joining the 24,600, 24,700 level, and then a dome-shaped topping pattern. And in particular, when this breakdown happened, if you look at the top of the dome at 26,400 and the horizontal base of the dome at 24,700, that's 1,700. That's the height of the dome. Subtract 1,700 from 24,700 gives us exactly 23,000. That's where the Nifty came down on to test, kind of earlier in the week, and then on Thursday it retested that at 22,900. As it retested that 22,900, slightly below the 23, look at RSI, positive divergence, a higher low on RSI. And then on the MACD histogram, a higher low there as well. So this near term has met its target on this dome-shaped topping pattern, and potentially we could expect to see a W-shape double bottom rally from here. So if you measure from 22.9 to 23.9, that's 1,000 points. Add 1,000 points to 23.9, 24.9. So that's about just little higher than this breakdown level at 24,700. We can see that there is support at that 24,900, and then there is also kind of gap that it left from that late February, right after the Iran war, is when the gap down collapse happened, around the 25,000 levels. 24,900 to 25,000, that's also where the 50-period moving average is at 25,100, is potentially some form of a near-term snapback rally is possible. A little longer-term chart on the Nifty paints, however, a much more bearish pattern. This shows us 26,300 and then 26,400 as a double top. The first top happened around 2024. The second top happened around 2026. We got that 26,400 in early February. From this double top, typically what you look for is a breakdown from an M-shaped double top. That M, the tip of that M, is at 21,700. From there, it went to the second double top, second of the right-hand side of the double top at 26,400. What's the measured depth? 21,700 to 26,400 is 4,700. Subtracting 4,700 from 21,700 takes us down to 17,000. So that's our target. 17K is our target for Nifty, which is quite a bit downside from where we are at 23,000 right now, is where we closed on Friday. So you're talking about 6,000 points kind of drop in Nifty from this 23,000 level. However, near term, before that drop happens, we expect a counter trend rally higher, as we showed on the daily chart. This daily chart potentially could now be a W-shaped double bottom, retest that level from 24,900 to 25, and then that breakdown is where it's going to take us down to 17,000. We don't recommend investing new money. Yes, for a short-term trade, yes, INDA is the ETF for Nifty. INDA is the key ETF, the iShares India ETF. It's worth the trade because if you put a stop loss right at the Nifty at 23, if you put a stop loss there, we could see a snapback rally here in Nifty, which would give a snapback rally in INDA. However, longer term picture, if you're really waiting to invest on India, we recommend let this pan out, let this technical pattern of the double top. Another key pattern of the double top is when we get double tops, the second top comes with a lower RSI, which is the market's momentum indicator. We see a lower high in that relative strength index RSI, indicating that the second top likely is a double top and not what bulls would call a cup and handle, because sometimes that second top becomes the right brim of a cup and then you get a shallow handle pullback and a breakout higher. If you do get that, that would then take us a lot higher. From a 21.7 to 26.4, as we said, is 4,700 added to 26.4. That takes us up to, close to 31,200 or so is where that would take us to, or 31,100 is where that would take us to. We don't think that's the case, because that was the case, we would not have seen RSI at a much lower high, wouldn't have seen the weakening momentum. This weakening momentum in the RSI and in the MACD, both at lower highs, indicate this a higher likelihood of a double top. We can see how far the moving averages have diverged from each other. A very big gap between the 50 period and the 200 period moving average. And this is the long-term monthly chart. Every candle here for the Nifty is a month of trading. So on the long term, reset back after having a very big bullish move from the COVID low at 7,500 to that 26,300. That's a factor of almost 3. 3 is 22,500. More than 3 is where it went to. That breakdown to a 17,000 cannot be ruled out, is why we are being cautious on India for sure. Emerging markets broadly, we talked about it 2 weeks ago, but the Indian market, we strongly recommend caution, waiting for a better opportunistic buying. And once we get that 17,000, we expect this to have because the overall Indian economy is very bullish. Currently, there are some setbacks that's shaping up in the world economy because of the Iran war. There's been articles about GDP impact. Citigroup's chief economist has talked about a 0.9% of the global GDP. The global GDP is at 2.9%. He thinks potentially this could have a 0.9%, so 2.9 could go towards 2%. And JP Morgan put even a more bearish expectation that the Strait of Hormuz that shut down major supply chains. We're not just talking about oil and natural gas. There are some core materials that, for example, helium powers the chip industry. When the wafers are produced in the fabs, the cooling down is done through helium gas. 35% of the world's helium comes out of the Gulf region. That's where the helium is produced and then shipped out to the rest of the world. So that's impacted. The Gulf, the Strait of Hormuz, that shut down. Pretty much no ship is being allowed to go through that region. Is not just impacting oil, and we know that oil has gone up 50%, shoot up in price. It's impacting India because India has to take a lot of its oil and import it from countries outside. But Gulf contributes a lot of India's oil as well. So India is already feeling the crunch of it. Small medium businesses that power their businesses through natural gas are impacted because of the liquefied natural gas not being able to come into India through these ships, the containers. And now the other key thing that's impacting India is India in many ways is an agricultural economy. Fertilizers, urea production, 45% of the world's urea production happens in the Middle East. So that Gulf region being hit hard, urea is not able to flow through that coming into India and other countries. So agricultural issues are also popping up. And as a result, the economy is likely going to take a hit, and that's what we could see, a sharp, quick pullback. I'm not saying it's going to happen just by the next week or so. This pullback from 26,400 to 17,000 likely could pan out like we got in 2022. 2022, we saw that it kind of spread out over 9 to 10 months. The peak happened around like late 2021, and we didn't get the bottom till October or November 2022. A similar kind of 9 to 10 month is what we expect this pullback to happen. And sometime around October or November of later this year in 2026 is perhaps where we could see that 17,000 level, where at that point it would be a very attractive buying opportunity in the Nifty. S&P 500, we had shared this chart pattern last week, is a layered chart. There is a rectangle pattern right at the top from the 7,000 peak to the 6780 to a 6775. We last week talked about a measured target on a 6775 to 7002. You're talking about 227 points. Subtract 227 from 6775. We said a target of this breakdown was giving us somewhere around 6,548. We broke below that. We can see a horizontal line key support level at the 6520 from the 6500 here. 6508 is the peak that it had in August. So around the 6500 level is where it broke down, or the 6550 is where we drew the horizontal line. It broke below it, but closed above 6500. Intraday on Friday, this was options expiration, quadruple witching options expiration. Massive volatility breakdown happened, and in that process, the low was at 64.73. We can see that 64.81 was the peak in August. So somewhere from the 64.70 to 64.80 is support, which was resistance before, is where it tested and rebounded by end of the day, closing above 6,500 right at 65.06. From here, from this breakdown of the upper end of the range to the second range, so there is a call it a band on the top end, then it came to the bottom of the second band. From this, if we get a recovery, which we think we could, we would potentially go and maybe test that 50 period moving average at 68.57, maybe even get a right shoulder move to that 69.20 like we saw here. We see a left shoulder, then a big kind of dome-shaped head, then a right shoulder move towards that 68.60 to 6900, then the breakdown. That breakdown from 65 to 7,000 is 500 points. Subtract from the 6,500. Anywhere to 6,000 or lower is where we think that breakdown could come on S&P 500. Now, this is what we're talking about as the daily chart of S&P 500. Near-term RSI is below 30. MACD is oversold at minus 77. We can see the histogram kind of oversold as well. This potentially is where we think from an oversold condition, and we'll show other indicators where we think S&P could be setting up for a rebound, is where we think we could get that rebound and then the drop. Why are we bearish on S&P? Look at the long-term chart from 2009. This is a secular bull market. We're not saying that the secular bull market is broken down. What we are saying is, if you look at the secular bull market, climbing up on a nice rising channel, join the lows and join the highs from 2009, it tested the top end of that channel, right around 7,002. And then this month, this is again a monthly chart, we got a breakdown. We got so far a 5.4% breakdown on that S&P 500 monthly chart. Look at, we've shared that before. Look at the MACD getting ready for a bearish cross, identical to what happened in 2022. So 4 years later, 2022, what happened? There was the Ukraine war from Russia. That caused the market to come down. A similar kind of situation is setting up. What happened in 2022 with the Ukraine war now in 2026 is the unfortunate Iran attack. And that's what's causing global supply chain issues, global recessionary fears. And that's where this drop. We can already see RSI. Just when last time we shared the chart had not dropped this much. RSI now is already at 62, falling very quickly from an overbought level above 75 all the way down to 62 in this just the span of the month. So far, this RSI started dipping lower. Guess what happened last time? From an overbought level, RSI came up to the 45 or so level, and from the rebounded higher. A similar kind of a drop is what we're expecting. Now, a typical test of what happens is not, this was a very sharp COVID drop from the top end of the channel to the bottom. We don't expect it to go that far. We expect it to go somewhere around the midpoint level, which right now a key support level that we think like held in 2022, held in 2025 tariff related drop is that rising 50 period moving average that we see here. The 50 period moving average in blue and the 200 period in red. 200 period is way down at 2,900. We don't expect it to get that far. We are expecting 6,000, as I talked about. That range breakdown from 65 to 7,000 is 500 points. 500 subtracted from 65 is 6,000. However, if the geopolitical uncertainty continues, the supply chain shocks and the concerns from that continues, we won't be surprised to see a retest of that 50 period moving average, which on S&P 500 is 5150. So a pullback towards the 51 cannot be ruled out. We can see RSI. MACD has barely started bearish crossing. The signal line black is just about to go below the red moving average line, and the histogram is just about to cross lower. When we got that pullback in 2022, it did not come in a straight line. It collapsed for the first couple of months, Jan, Feb. March, we got a snapback rally, and then the fall. We expect a similar kind of a snapback rally. Look at the snapback rally in RSI. As RSI dipped, there was a bit of a upward bump when the snapback happened, and then RSI dropped. Similar kind of a snapback is what we're expecting into March into April, and then a peak in May around that 6,900. And then from May, we are looking for a bearish summer pop up, like we got a bearish summer in 2022 towards a fall low. Somewhere around October or November is where we could get that collapse. And by that time, because this is over time, we're going to see that movement down. We wouldn't be surprised to see S&P definitely go below 6,000, potentially test that support line of 50 period moving average at 5,100 is our target. Now, why are we looking for a near-term bounce? Let's look at the sentiment with respect to put-call ratio. There are three put-call ratios. There is index put-call ratios, there's overall total put-call ratios, and there's one just for equities. Here we're looking at the CBOE Equity Put-call ratio. We see it testing a key level, right? It tested in 2024. It has already taken out the tariff high from 2025 April. It took out the September and the November high, and now it is very close to the peak that we saw in 2024 twice, in May and then towards September, early September, at that 0.68 level. We can see it's right there. Moving average is 0.68. It's right at that level. We could see the put-call ratio pull back. Put-call ratios rise when there is fear in the market, when there's bearish sentiment. Puts more buying than the calls, and hence the put-call ratio, the puts increase over the calls, and hence the ratio climbs. However, having now come up quite a bit from where we were just not too far back, near 0.52, we rose pretty quickly from that 2025, call it the October low or early November low at 0.52 towards the 0.68. Pretty quick rise of bearish sentiment. Now we could see, with any kind of truce or any kind of positive news on the Iran war front, could give us a quick rally, and that's where the put-call ratio could come back. And then from there, after that, we do expect, if the market has to sell off towards that 5,100 or below 6,000 for S&P, this put-call ratio would climb and potentially climb all the way up to the 2023 peak near 0.92 is where, or sorry, 0.82 is where we think that could climb up to. So after it breaks 0.68, can it go up in a straight line like it did back in 2023? Possible. But the fact that if you look at how it did in 2022, it did not go up in a straight line. It went in a zigzag fashion. So first it went up here, then it pulled back, went up next level, pulled back, and then that had a sharp towards the September is typically the most bearish part of the year. September through November is where we saw that sharp climb from somewhere around the 0.64 level or so, all the way up to 0.98, 0.99 is where the put-call ratio went up to. Could we go up that far? It's possible. If we get a very sharp, like that time we had over 20% S&P pullback, over 30% Nasdaq pullback. If that's what shapes up, then potentially the put-call ratio could climb all the way back up towards the one level, which is 0.98, as we are seeing in here. This is, by the way, not the actual put-call ratio, but the moving average, the 30-day. This is an intermediate indicator. That's why we're smoothing it out with a 30-day moving average of the put-call ratio. So that 30-day right now from 0.68, we expect, having tested that peak from 2024, could pull back, is where we think potentially from a contrarian perspective, from a sentiment perspective, market could be seeing a near-term rally. Another ratio which takes out money managers, market makers, and only looks at the individual investor calls and puts by something called the ISEE index chart. And if you look at its equity only put call put, they do the other way. They don't do put call, they do call put. That had gone very bullish towards early part of the year closing towards almost 300. From that 300 level towards that early part of the year, look at how far it has come down. It's come down to cut in half from 300 towards the 150 level. So that indicates more, puts over calls, and as a result, the call to put ratio is coming down. It was 3 times calls over puts towards late last year. From the bullishness, we have now 1.5 times calls versus puts, because this is again not the money managers, as you clearly see here. This is taking out the investors, taking out the money makers. So market makers and firm trades are not in here. They're not considered in this ratio. This is primarily the individual investors buying of call and put ratio. So because money managers, we know, have to always take the other side of the trade, and they're the market makers, that distorts these ratios. So in here, we can see the 50 period moving average in purple, and we can see in the golden color the 20-day moving average. We can see that the 20-day had collapsed already below the 50. It's beginning to turn higher, but if we get further sell off, then we can expect the call to put ratio to come all the way towards 1, as in puts would almost equal up to the number of calls. Right now, we are at 1.5, so we still have more calls than puts, but that could come up to a ratio of 1 that we didn't see here. But if you go to a little longer term period, you could see that we had gone all the way towards the 100 level in the past. So right now, from the 150, we expect some form of a snapback as the CPCE comes down. So we can expect the call to put ratio to go back higher with more call buying as the market rallies back. Now, VIX, which is the other key indicator, is potentially setting up as a cup and handle pattern. At the 2025 tariff peak, it had touched 60 temporarily. This is a weekly chart for a week, and that's end of the week had already come down from the 60s to the 30s. From here, we can see towards third week of April, we hit a 35 level, came down to 1338, and went to 3530 recently, 2 weeks ago. This is right in the first week of March when the war struck. That 13 to 35, you're talking about roughly 22 points in VIX. 22 added to 35 takes us towards 57, back towards that 60 level. That's where we think VIX could head up to by the time the market breaks below 6,500 after that snapback rally. Initially, we now see for the last couple of weeks, VIX is pulling down. We have seen that kind of a VIX pull down like in 2022 as well. We can see that went up to, in the initial climb from 16 to 37, then it pulled back to 18, and then it zigzagged between that 18 to 35 over that entire period. So in a high volatile environment, we expect a similar kind of a upper band VIX movement from 18 to 36 over the next several months. So here, we've already kind of pulled back towards 26. The lows of the week was towards 21. So we could be hovering and coming down back towards the 18 to 20 level as the market has a counter trend rally, is what we think on the VIX chart. So VIX, as to sum it up on the cup and handle, from a 13 to 35 is 22 points added to 35. We are looking for a VIX target at 57 by the time the cyclical bear market correction plays out. QQQ is the Nasdaq-100. That's the technology-driven climb in S&P 500. We know that the top 5 weighted S&P 500 stocks are all Nasdaq, all technology stocks. What does it show us? A double top pattern. 636 tested twice, once in kind of late October and then once in late January. From there, that breakdown, the key breakdown level is 579.99 or 580. It broke down temporarily on Friday at 578, snapped back and closed at 582. We think this will eventually, right now it looks positive because at the test of 580, we can see RSI did not break down to a lower low. It's maintaining a horizontal level at 35. At the low 30s is where the RSI is. It didn't break down to a low low. We can see that MACD is also maintaining at that horizontal level, hasn't broke down to more oversold levels. If this maintains near term, we could see a QQQ snapback rally as well. It's not just the S&P. S&P will be driven by the QQQ technology stocks. As a result, we expect a snapback rally in QQQ, ideally maybe something like a rally towards, like we see here, if this is kind of a short left shoulder and then kind of a bigger dome-shaped top from here towards that 680 again, 580 again, 580 to a 612 or a 610. Right now we see the 50 period is at 610. So if the S&P 500 is to climb up to test its 50 period, we can expect a snapback rally in QQQ to test its 50 period. The other key reason why we are bullish on the QQQ and expect a counter trend rally is something called the bullish percent index. This is a technical breadth indicator. What percent of the QQQ stocks have bullish looking point and figure charts? Point and figure charts from technical analysis is another pattern of drawing charts, unlike the candlestick. Candlestick is what we've drawn here. Those are, every candle in this case is a price pattern over time. We see time as the x-axis. Point and figure ignores time. It only looks at price levels. Hence, the point and figure charts have better predictive power price-wise on where the market's long-term trends are. And so if you look at point and figure charts that are still bullish in the Nasdaq-100, that's showing us a positive divergence. Look at where it is right now. Right now it is at 38. What happened in February? It has a 35. What happened in November? It was a 29. That's a pattern. We can draw a straight line across it, a pattern of higher lows. This is positive divergence. Positive divergence, why? Because the market is retesting the November low at 580 on QQQ, but the bullish percent index is telling us it's a high low. That means there are fewer bearish stocks on the Nasdaq-100 like it was back in November of 2025. So that bullish pattern is giving us a positive divergence, as in a more improving market breadth on the QQQ relative to the price of QQQ. So retesting 580 twice from November, but the bullish percent is at a higher low, indicating market's breadth is at a stronger breadth than it was in November last year, gives us the positive indication that we could be seeing a counter trend rally soon. Now I'm going to end with a couple of key sectors on QQQ. One is software. Software already had been washed out before this drop happened in March. Software got washed out in February. This was the what people used to call the DeepSeek moment into the AI sector back, a year back. That DeepSeek moment played out with the Anthropic launch of their agentic technology. It completely took the world by storm. They introduced the agentic technology called Cowork, and the world started fearing that all these SaaS software players will have a breakdown because AI will effectively replace what the SaaS softwares do. And with the agents, you're going to have less human licenses bought by the respective licensees of the softwares. They're going to be mostly using agents to drive the work. As a result, software companies are going to get hit bad. So across the board, starting off with even companies like IBM, which have mainframes that power a lot of the enterprise technology, got threatened, thinking that COBOL, which runs a lot of that, will now be reinvented with newer software that the agents will write and will not need the mainframes anymore. So IBM, as the behemoth of the technology industry, got hit hard. Microsoft got hit hard. IBM, just so that you realize, is not just a technology selling hardware. It sells a ton of software. The mainframe software is very high margin. That's how IBM got hit. Microsoft got hit. Across the board, the top companies that are in IGV, which is the iShares software ETF, got hit hard. And so that, look at its collapse from 118, a double top here in September and October. From the 118, it collapsed all the way from 98 to 118, measured to a target something around the 80 level or 79 level. It broke further down towards 76. However, in the collapse in March, look at what happened. It put a higher high when it first counter trend rallied in early part of March. It put a higher high from the high at 87. It put at 88.5. Look at the right shoulder pullback. This is an inverse head and shoulder where the neckline is usually flat. In this case, we have a positively sloped neckline. If you join the highs, 87, then to 88, and then around here, this inverted or inverse head and shoulder with the left shoulder here at 79, right shoulder that happened last Friday at about 82, is now poised for a climb higher and a breakout. If we get a breakout, the measured target is 76 to 88. You're talking about 12 points. Add 12 to 88, 100. 100 is from where we effectively broke down. If you look at 99.34 and the 98.7, roughly that's 99 to 100 or 98 to 100 is where roughly the breakdown came from. So we expect a counter trend rally in software towards that 100, and that will help the QQQ rise its climb. In particular, remember, a big part of the top 5 stocks in QQQ is Microsoft. If Microsoft sees a counter trend rally taking IGV higher, it'll help the QQQ get a climb higher as well. Semiconductors is showing unbelievable strength. Look at the 374 level in its ETF SMH. It tested it twice. While the software topped out with 2 double tops at 118 and broke down, semiconductor was the other way around, because they are independent of software or the of the agentic technology. The more agentic is better for the semiconductor stocks, because then people will be buying more chips, whether it's the memory chips that SanDisk and the Western Digital and others make, or the GPU chips that NVIDIA and AMD sells. So semiconductors have had a bullish period, and look at where its key support level is. What used to be resistance that it broke out from, that 374, that measure target from 314 to 374 is 60 points. At 60 to 374 is 434. It came close. It didn't get quite to 434. It get to 427, and then it broke down. However, it tested that level twice, the 374. It tested it in early February, and it tested it the first part of March. And then it broke back for a snapback to 404. On Friday, we would expected this, if it was completely bearish on semiconductors, to break down. This was their chance to break this down below 274. It's still 374. It's still possible. We'll see how next week pans out, and we could turn out to see this breakdown. If this breaks down, this is a very good indicator. S&P will no longer have a rebound. We can go in a vertical line straight down towards that 6,000 level from the 6,500 break. But if the software, which we are saying is an inverse head and shoulder, if semiconductors hold that 374, testing it twice successfully and then breaks higher, 374 to 404 is 30 points. Added to 404, 30 points is 434. That measures right back to the target that we talked about. 314 to 374 is 60 points. Add 60 to 374, 434. So if this cup and handle from 374 to 404, 30 added to 404, maybe 434, a slightly higher high from the 427, is what we think SMH is headed towards. So with that, let's just sum it up quickly. We talked about emerging markets in our YouTube video 2 weeks before. We talked about watch out for the bearish reversal emerging markets. The key emerging market is India. We looked at the NIFTY index in India. We talked about the dome-shaped topping pattern. That near-term breakdown target from 24,700 from a peak at 26,400 was 1,700 points. Subtracted from 24,700 is 23. We met that target at 23. Potentially a W-shaped double bottom is forming. So 22.9 to 23, a 1,000-point rally from 23.9 up to 24,900 is where 24,900 to 25,000 is where we think Nifty could have a near-term rally. Long-term, very bearish on Nifty looking for a double top. That breakdown from a double top at 26.3 in 2024 and a 26.4 in 2026 measures to 17,000, a lot lower. Look at the negative divergence that confirms the double top. The real double top will not be confirmed till we break below the tip of the M at 21,700. So expect some support at the 21,700, but that eventually we think could break if this is a double top, and that measure target is 17,000, which is possible if the supply chain crisis that's hitting India hard, as you talked about, urea, the nitrogen, the fertilizers that drive India's agricultural economy, the big part of oil and natural gas. India's energy is hugely reliant on the Gulf. Those things could impact India's GDP and India's economy broadly is what we are worried about. S&P 500, we had in last week's chart talked about a double layer. The top part of the rectangle range from 67.75 to 7,000 had measured to 65.48. We got that thing met, and we got further down towards a key level at the 6,500. In fact, we can see 64.81 was that peak in August. So it tested that 64.81 at 64.73. Managed to close above 6,500 by the end of the market on Friday. By the end of the closing, it got slight snapback and closed above 6,500. We're going to watch this. Why we feel that there is potentially a possibility of a rebound. If that does come through, we could then effectively form the right shoulder like we have a left shoulder here. So this left shoulder from 6,500 to 6,920, then the head to 7,000, and a right shoulder to maybe the 50 period moving average at 68.57 or slightly higher to 6,900, and then the break lower. Longer term chart shows us a rising channel all the way from 2009. This is the secular bull market is what's causing the channel to climb higher highs. We think that was going to be intact. We don't expect the bull market to end here. We expect a retest of maybe the rising 50 period moving average, which right now is at 5150, at 5100. Like we saw, and these are in the secular bull market, we get occasional cyclical bear market. So in cyclical bear market, we got in 2025, where we got a 22% pullback in a span of 3 months. Then in 2022, we got a secular bear market where 48.18 came down towards somewhere around 3,600 or so. So that was a bearish cyclical bear market. We expect another cyclical bear market. Similar patterns in 2022 are shaping up. In 2022, you can see that the MACD bearishly crossed. We have a bearish cross in MACD. You can see RSI crossed below 70, came all the way down towards the 45 level. We are already at 62 level in RSI. We can expect a counter trend rise like in 2022, a counter trend rise. RSI is slightly dipping higher for a couple of couple of months going into May, and then maybe the drop resumes where MACD goes, kind of prints out a bearish MACD histogram below the center zero line like it did in 2022, and from there we revert higher to again new highs way above 7,000 is where S&P could climb. But near term, that cyclical bear market pullback towards the 50 period can't be ruled out. Why we think the counter trend rally is coming is because of the sentiment being very bearish. The put call ratio is retesting the 30-day moving average, the put call ratio, the equity put call ratio, CPCE, is testing the 2024 peak at 0.68. It really goes up as we see in 2022 in a straight line. It goes up, comes down with the counter trend rally, goes up, comes down, and then climbs. So we think potentially CPCE could retest that level at 0.98 if we get a 30% or so pullback in S&P 500. Because if we look at 7,000 towards 5,100, that's almost close to a 1,900 point. 7,000, 30% correction is 2,100 points. So 1,900 is almost close to a 30%, maybe 28% or so bear market on S&P could take us towards that 5,100 target. That 51 again is from that 50 period moving average is where the 51 is. And if 2022 pull back to test the 50 period, and the same thing in the tariff collapse in 2025, coming to test the 50 period, that likely could be a support level and a magnet pulling the bear market towards. So that, and the other key indicator is the ISEE call to put ratio. So it's different from the CBOE. CBOE has the market makers, the money managers in there. This one is taking all those out, just looking at the individual investor call put buying. This one is showing a sharp drop from extreme optimism at over 305, falling down towards 150, getting cut in half is what happened to the call put ratio. That indicates that there were 3 times calls towards that ratio in early January. And from there, from 3 times of calls, it is now at 1.5 times calls to puts. That could further kind of decline if the market collapses further. But near term, we expect this to climb higher as there's some call buying coming from a counter trend rally. But eventually, we wouldn't be surprised to see this collapse all the way down towards the 100, 120 to 100 level, where the calls and puts level up on the retail investors level. VIX, we think, is temporarily going to pull back from 35 towards 18, as we have seen in the 2022 timeframe. VIX became an upper bounded kind of range, move from 18 to 35. We expect a similar kind of a high volatile environment. Not going to be seeing the 12s and 13s, at least this year. Expected to be range bound between 18 to 35. So pullback towards 18 is possible in the next few weeks if the market gets that counter trend bounce. And then from there, that cup and handle from a 13 to 35 is 22 added 35.57 is where we think VIX could climb, retesting that April 2025 high towards 60 is where we think VIX could eventually climb. QQQ near term, we think a counter trend rally pops up at a key testing of 580. Why we think it's possible of near-term counter trend rally is because the bullish percent index printing a higher low. That's beautiful positive divergence. From a bullish breadth index, there are fewer stocks that are bearish than it was in the 580 last test in November of 2025. So we can see it's the bullish percent index has climbed from 29 to 35 to 38. So that higher lows in the bullish percent index indicates QQQ is at a relatively better position to get a counter trend rally. How far could it rise? We think, like we see on this part here, from 580 to 612, 610, 612 is 610. We already see is where the 50 period moving average is. So a counter trend rally from 580 to 30, 32 points is where we think QQQ could rally towards. And then the key 2 sectors are software, IGV, a beautiful inverse head and shoulder we think is forming. Of course, that could all change if it breaks down below 80 and goes towards retesting the lows at 76. But we think showing the strength on last week when the market broke down to new lows in QQQ. IGV did not. It held strong above the 79 level. So this is a slanted inverted head and shoulder. So that breakout above 88, 89 takes us towards 100, we think is what's going to happen in the software. Semiconductors key holding the 374 support level twice. On Friday, it could have broken down below it. It did not. It held it. We think potentially this is setting up to break above 404, climb that 30 points from 404 to 434. And that would effectively be a broadening pattern on the top on SMH. Slightly higher high, 420, 427 to 434. And in the next few weeks, after the 434, we think then at that collapse, as S&P breaks below 6,500, QQQ breaks below 580, SMH will break 374. Till then, 374 has held a strong support. Expect a semiconductor counter trend rally as well to new highs to 434 is what we think could happen. Good luck investing. We'll talk to you next week. Thanks for listening in.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.